So the idea would be buy country ETFs. So if you want to buy Germany, I think EWG this is an ETF for Germany index fund. MSCI is short for Morgan Stanley Country Indexes. I think these are now managed by BlackRock. All you have to do is buy the stock. The return on the stock is very highly correlated with that actual index. And these indexes are value weighted. So the larger is the company, the higher is the rate. For example, if you look at the largest weight on MSCI Germany is SAP. It comprises 11.7%. Siemens, Allianz, which is an insurance company, Deutsche Telekom, I don't know what this company is. Münchener Rückversicherungsgesellschaft. That's Munich something company. I don't know what that is. Mercedes, Bayer, yada yada yada. Okay. Buying those individual shares is going to be a lot costly for you, because as you can see, they're all quoted in the Frankfurt Stock Exchange. Well, you have to have a broker there. They're going to charge you brokerage fees. Plus, you have to take the exchange rate risk. You have to actually convert your dollars into euros and buy it in those markets. Instead, you just buy this ETF. It's traded just like any other stock. ETF is short for exchange traded fund. And just like you can do it for the overall stock market, you know, SPY for S&P, and if you want to do overall stock market, Vanguard Total Stock Market, which has very low fees. Let me see how much they charge in fees. Just 3 basis points. For each $10,000 you have, they charge you only a $3 maintenance fee. That's it. On the other hand, the German one is going to be costlier. Where is it? That's $50 for 10,000. That's partly because it does cost them more to maintain that. Or alternatively, you could invest into ETFs or ADRs of individual companies. For example, suppose you want to invest into BioNTech. Okay. There is an ADR, which is short for American Depository Receipts, which is essentially allowing shares of BioNTech, which is a German company. I think they moved their headquarters to England now, but yeah. Allowing those shares to trade in New York Stock Exchange or NASDAQ, right? You could also trade their shares separately in Frankfurt. I think their name was the code is, let's ADR, I don't want that. Yeah, 22UA.F. But that price is in euros, and they trade at different times. I mean, right now the Frankfurt market is closed, but the US market is still open. And ADRs can also be converted into regular shares. So if there's a big price difference between the two, that's going to be eliminated. The benefit of trading the companies that has ADRs has to do with regulations. For a foreign company to quote their stock as an ADR, they have to accept the regulations of United States regulators. So that means that accounting standards have to satisfy US accounting standards. So BioNTech, they have an ADR, they have to disclose their earnings using US accounting standards. That makes a big difference. Again, this being a German company, you may not worry about it that much. Let's think about a Turkish company that has an ADR, Turkcell. This is the largest cell phone operator in Turkey. And what's their market cap now? Let me see. Close to $4 billion. I mean, it has gone down somewhat over the last 5 years, but suppose this company did not have an ADR and you wanted to buy their shares in Istanbul Stock Exchange. Obviously, they're subject to Turkish accounting regulations. And you are a US investor. Would you have as much confidence in financial statements of that firm that needs to satisfy only Turkish accounting standards versus a firm that has to satisfy US accounting standards? In general, even if the foreign accounting standards are stricter, individual investors typically are biased. They think, okay, I don't know anything about their accounting standards, so I'm going to assume that it's loose. So they actually apply a discount to shares of the firms that are not ADRs. In fact, there is research that shows otherwise comparable firms having an ADR adds anywhere from 10 to 20% in valuation. Why? US investors think that having those ADR means they're subject to better accounting standards, so there's not going to be any shenanigans. And for certain countries, that means big. I'll give you an example. I don't know if they're still doing it, but in the old days, there was a term that was invented in Korea. It was called tunneling. In Korea, industrial organization is based on industrial groups called chobols. They're similar to keiretsus or the old zaibatsu before war in Japan. And these are basically holding companies. These holding companies have interest in all sorts of stuff. You know, Samsung is one of them, you know, Kia, Daewoo, and that sort of stuff. But there is a lot of layers. I'll give you an example from my days in Turkish stock market. There was a group that was basically most of the media kind of ownership. They had TV stations, they had newspapers. At the top, there was the main holding company. That was primarily owned by family of the founders, okay? And that company was not public. But that company owned a publicly traded holding company, but they owned only 50% of that, okay? Or 51%. The rest were publicly traded. And that holding company owned a media holding company. Same thing, then media holding company owned the newspaper. But if you look at it, the direct ownership of the founding family was about 1/8 in the newspaper. But through successive layers, they had total control. Now, what's the biggest input to a newspaper? Material. price. Paper, right? In this case, the family company owned the paper production company, 100%, okay? That's not public. This paper company sold the paper to the newspaper company, but they sold it at a premium, okay? So let's say the market price for the paper was $100. This paper company sold it to the newspaper at $120. That's $20 overcharge. You're thinking they're making 20 here, they're losing 20 there. But all that extra 20 goes to the family. They own the entire paper company. But directly or indirectly, they own only about 25% of the newspaper. So that $20 lost it goes from the pockets of 75% public ownership. They effectively stole $15 from public investors by overcharging and keeping the extra to themselves. Koreans actually call this tunneling. You basically dug a tunnel from the newspaper company to the main holding, and from that tunnel you sent $15. Now, if you were using US accounting standards, everything was going to be consolidated. There is no way you could have stolen that money. But in the Korean accounting system and in the old Turkish accounting system, it's not like that now, but in 90s and until 2010 it was like that. You could actually legally steal that money because you didn't have to consolidate. So if I'm a US investor and I know nothing about their accounting standards, and probably I don't even want to know anything about their accounting standards, I'm going to prefer companies that has ADRs versus companies that do not have ADRs. That's why there's a big valuation premium. Otherwise, ADRs also allow quick access to bigger markets. Normally, typically only institutional investors invest into especially developing country markets directly because they have enough juice to get good brokerage rates. If you went to a Turkish brokerage company and wanted to buy and sell stocks, they'll probably are going to charge you 0.2, 0.3% per transaction. But if I'm a big investment fund, I can get away with 0.05 easily. But if I have an ADR, then I have direct access to US individual investors. It's right there. We talked about those. You can read about those yourselves. Yeah, you can read the rest yourself. We're gonna kind of do optional topics in the remaining time. So think about what sort of stuff you would like me to talk about in international markets. Let me know. If I don't hear anything from you guys, I'll make up some topic and we'll talk about those. All right? I'll see you guys Monday.